Hey, Jason here. Today's video, I'm going to answer the question, is Nokia a great investment right now? I'm going to answer this for CryptoIndex, who asked me to evaluate them on YouTube. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a new video. I release new videos all the time. Okay, so if you've seen any of my recent videos, you know what's about to come. Again, I apologize for this. I have to do this. I don't want to do this, but I have to because every time I forget to do it, I get nasty, disgusting comments in the YouTube comments below. So these are for these analysis videos. I was going to say articles. These analysis videos are for informational purposes only, to help you learn how to become a better investor faster by helping you figure out how to spot things by looking at companies' financials that will help you analyze a company faster so you can get rid of the crap companies faster and spend more time evaluating the good companies. This is based on my personal preliminary analysis checklist. This is the visual part of that checklist of my entire process that I go through every time I look at a new stock. I do not own any stock in a long position in any stock I talk about, and I do not short ever. So I do not gain from any fluctuations in the market either way from these videos. So I have to put that in there. Again, I apologize for that. But why should you listen to anything I have to say? In the first 9 years of my career, I produced 23.5% returns on every year on average for the portfolios I manage. This is just behind the 24.2% returns Warren Buffett produced in the first 9 years of his career. And these numbers and these results actually make me one of the best stock pickers in the world over the last 9 years. I don't say that to brag. Frankly, saying that makes me a little queasy just saying it because I don't like talking about myself and my results. The only reason I'm saying that is to prove to you that I actually know what I'm doing a little bit. So, okay. So again, I apologize for that. Every time I forget to do it, though, get nasty, disgusting comments. So here we go. We're going to analyze Nokia for CryptoIndex, and we're going to find out if this is a great potential investment today. Okay. Down 6.5% today. I wonder why. I wonder if there's major news. I'll look at that in a minute. Market cap. Surprised that's low, frankly. Nokia. When I was growing up, Nokia. Literally everybody, I think, probably on Earth, at some point, if you had a cell phone, you had it the Nokia brick phone that was pretty much indestructible. Now, they're mostly known as a 5G company, though, and they're helping with the 5G build-out worldwide. PE, again, I don't care much about this, but I do look for it to be under 20, this forward PE here, and at 19.3, it falls underneath that, so that's one sign the company might be undervalued, but again, I don't put too much stock into that number, which you'll see in a little bit of numbers that I care more about. Okay. Huge fall in revenue over the last decade. Again, this is largely due to their declining position in the cell phone market, and they're transitioning to a 5G network and 5G infrastructure build-out company. They do stuff in 4G as well, which is part of this, but now their big thrust is to build out the world's 5G network, which is why you see the huge decline in revenue here. Actually dropped from 38.7 billion in 2011 to a low of 12.7 billion in 2013. Now it's back up to 21.9 billion rounded up, but this is still, what is that, 16, 17 billion lower than a decade ago, which frankly, again, is not surprising because of their massive transition that they look to be pulling off reasonably well. And again, I've talked about this in other videos. Most companies do not pull off major transitions in their business. I talked about that in the GameStop video exclusively. Nokia finally looks like they're taking advantage of this new trend and transitioning their business well. Again, but even having said that, their revenue is still lower by a lot than it was a decade ago, which isn't necessarily a huge deal, but that is one sign to watch for the company as it transitions. Another, operating income. They actually have more operating income now than they did in 2011 when they had far higher revenues. So that's fantastic, which means their operating margins are a lot higher, and they are. I look for anything above 10% on a consistent basis here. They surpassed that only 2 years, 2014, 2015. And two of the years were actually negative. So without doing the actual math here, I'd guess their 10-year long, or their 10-year average operating margin was probably about 4 or 5%, which doesn't even, it's about half. Again, I look for anything above 10% on a consistent basis. So it doesn't meet my threshold there. Earnings per share, don't really care about because of net income and how easy that is to manipulate, which I've talked about in other videos. They cut their dividend. They started lowering their dividend, and then they finally cut it last year, I think due to COVID, or restructuring, that probably all that as well. Shares. So this is how they've stayed alive and built most of their growth. They have, in 2011, they had about 3.7 billion shares outstanding. Now they have 5.6 billion shares outstanding, which means they've increased their share count by right around 2 billion shares. And off the top of my head, that's what, 20-ish%, 25% dilution, if I'm doing the math in my head correctly, which I'm frankly probably not. But either way, when you dilute shareholders, it lowers the value of the share over time on a per share basis, because companies over the long term are based on the profits and the cash flows they produce. And when you lower, or when you increase, in this case, the amount of shares that the company has by a large margin here, then that decreases the per share value of the company's stock, which I can almost guarantee we can see here by going to the chart. I would guess from the share dilution and the transition of their business that their stock price has massively declined over the last 10 years, 20 years, and it has. So just in the last 10 years, from about 2010-ish, their share price is down from about $15, $16 a share in April 2010 to $4.28 a share right now. That is the power of share dilution. And again, even if you go back further, at their height, and this was during the tech bubble, of course, and they were at their height during this time frame, 2000, 2005, where, again, almost everyone on Earth that had a cell phone had a Nokia. Their share price back then was a high of $58 a share back during the tech bubble, and it's only $4.28 a share as of this recording. Again, how did I know that? That they most likely, their share price had decreased from this single metric right here, just the share price, or just the shares increasing by 2 billion. This is the power of dilution on your shares, because over time, again, companies are always valued on the profits and the cash flows they produce. And if they produce lower cash flows and profits per share, which is what happens when you increase the share count, that decreases the share value almost 100% of the time. That's how, just by looking at this one metric and the trend over the last decade, how I knew with pretty good certainty that the stock chart would show a huge negative decline over the last decade. And again, even going back further, the last 20 years. Because of that, also, because of the dilution, also, book value per share has declined. It's about halved, a little bit less than halved in the last decade. Again, I pretty much knew that was coming because of the share dilution, also combined with the massive transition in the business. I want this number to be going up over time because it means the underlying intrinsic value of the company is going up over time in general. Again, barring for things like increases in goodwill and intangible assets. And I think I talked about those in the Cody video and the ExxonMobil video. And you can get all of our previous videos in this series below in the description for free as well. Free cash flow, 1.3 billion. Again, free cash flow is up in the last decade. which I kind of figured because of their operating margin being up. But again, that's a great sign, though, that they're actually transitioning and transitioning well. This is a bit surprising. Their ROIC is negative for most of the last decade, and even negative in the last 12 months when they were profitable on an operating income. And that's why I didn't. Again, this is how little stock I put in net income. I didn't even notice that they had negative net income. And I explained why I don't like net income in several videos on the channel, but I didn't even notice that. That's how little stock I put in net income. So that's why their ROIC is negative, is because their net income is negative. I look for anything above positive 10% on a consistent basis for ROIC, and they've only again surpassed that 2014, 2015, and most of the decade they've been negative. So again, doesn't come close. Free cash flow to sales, I look for anything above 5% on a consistent basis. In the last year, they surpassed that about just under 6%. Most of the last decade, they've been negative, though, again, outside of 2014, 2015. Decent amount of cash, about 23% of the balance sheet is in cash. That's good. Intangibles, we'll get to that in a minute. I'm not a big fan of intangibles. If you've seen some of my previous videos, or most intangibles, I should say. Their total liabilities as a percentage of the balance sheet is relatively low at 65%. Short-term debt is low, ultra low at 1.5%, and long-term debt is low again at 13.8%, which frankly is a little bit surprising to me, knowing their business model and being essentially an infrastructure build-out company, which typically that requires high costs and upfront cost, and usually requires more debt. So I'm a little surprised about that. Okay, here's a big problem. All the stuff before this has been kind of minor. The profitability is a big deal, but it's not a massive, massive, massive deal, especially, again, because I know they're going through a massive transition. This is a big deal, though. This is partly due to this cash conversion cycle increasing from 24.4 days in 2011 to 64 days in the trailing 12-month period is a gigantic red flag. Again, yes, I know they're going through a massive transition, and that will affect this. But when the cash conversion cycle rises, it's pretty much always a bad thing. It means the company is having a harder time selling stuff, which is this number, days sales outstanding. This has gone up from 69 days, 70 days in 2011 rounded up to 88 days rounded up in the last year, which of course means it's taking about 18 days longer for them to sell stuff. When it takes you longer to sell stuff, it means you keep your inventory levels go higher, which is what happened here. They've more than doubled their inventory levels from 2011 to the trailing 12-month period, from 32 days to 69 days. And typically when that happens, you have to pay your suppliers longer because you're not generating as cash, or you're not generating cash as fast as you once were. So you have to pay your suppliers in a longer time period. This has gone up from 78 days in 2011 to 93 days in the trailing 12-month period. So what this really means, this cycle measures the time it takes for a company to sell its products, or let me start at the beginning, to take cash that they own, to buy inventory, to sell that inventory to generate more cash, and then to repeat the cycle. This is one of the most important metrics I look at, and frankly, pretty much nobody, I don't think I've ever seen another investor talk about this metric. It's one of my favorites for that reason, but also because it literally can tell you 10 or 12 different things just with this one metric. So because of this, because of these rises over here, I know not only that they're having a hard time selling stuff, which I already said, but that's led to higher sales, or it takes longer to sell stuff, so their inventory levels are higher, which could lead to issues on the balance sheet. This, and we'll talk about that in a minute. This also led to taking longer to pay their suppliers. Typically, yes, if you can do that, if you're a giant company and you have huge power, like say a Walmart, you can do that. You can push out your paying your suppliers longer, and it's not necessarily a bad thing. When a company is going through a massive transition, though, or in a new industry like this, typically when you see somebody pushing out their suppliers, that means they have to. They're not doing it just because they want to, like a Walmart or an Amazon might do, for example, to keep more cash flow in the business. They're doing it probably because they have to, because they're not generating enough cash flow on a regular basis up here on the days inventory and days sales outstanding. What that could lead to is suppliers getting pissed off. And that is a really bad thing, because if you don't have suppliers supplying the products, in this case, infrastructure and parts and pieces and products for the 5G build-out, that could be a bad thing, because it could destroy the entire company, essentially. Again, I'm not saying that's going to happen, but that is an extreme case of what could happen. This is why this number is so important. And again, now let's go to the balance sheet. How do I know if there's likely issues on the balance sheet from that one number? Because again, in most cases, when you see a cash conversion cycle rise a significant amount in a short time period, or even in this case, a long time period, 10 years, it means there's probably issues on the balance sheet. So let's go directly to the balance sheet. We'll come back to that other stuff later that I normally hit, but I want to talk about this because it's an important number, or it's an important illustration of the power of this cash conversion cycle. So let's actually go to the annual numbers here. Normally I look at the quarterly numbers. In this case, I'm going to look at the annual because I want to see the how they change over time. Specifically, inventory levels. They're actually down a bit, surprisingly, on an absolute dollar basis. Okay, so here's the issue. It's when a company has inventory and sales issues, it's either one of two things. It's either inventory will rise, which is, again, that's a bad thing because that could lead to write-downs and impairments and destruction of value, or it's an accounts receivable issue and people are ordering less stuff, which is what it is here. So, total trade. Okay, so even with $1 billion plus in unbilled revenue and accrued income, their inventory or their accounts receivables are about 600 million less, 800 million less than they were in 2016. Again, how did I know that was one of these two issues was likely going to, or one of these two things, accounts receivable or inventories, was going to have an issue? Because of what the cash conversion cycle told me. So the number just isn't important by itself. It tells you, gives you clues on where to look for other potential issues. When accounts receivable, let me back up. So over time, accounts receivable and inventory levels should rise and fall at about the same pace. If they do that, it shows the company is selling stuff well, and it's selling stuff on kind of a normal quote-unquote basis. If either of these two are rising or falling at a faster or slower rate than the other, it means there could be issues in, again, selling stuff. There's too much inventory, there's the wrong inventory, all that kind of stuff, which again, I all gleaned from the cash conversion cycle. In this case, inventory levels are a little bit lower by about, 300 million? And these are in euros. 300 million euros less in inventories over the last 5 years. Accounts receivable have fallen by a much bigger, where are we at? By a bigger amount. So again, looks like they might be having some inventory and sales issues, which again, they are. I can tell that just by looking at the cash conversion cycle. So what does this mean for the company? Like on a real world sense, from an investment perspective, it could lead to write-downs. It could lead to discounts, which is lower revenue and lower profits. It could lead to issues with suppliers if they don't have enough cash flow to pay their suppliers. Or the issue we already saw is that they're pushing out their paying their suppliers longer because they don't have as much cash flow cycling through the business because the cash conversion cycle is moving slower now. All of these things are not good, because it shows you that there's something wrong in what they're doing. And again, I don't work for Nokia, so I don't know the internal numbers. And frankly, as an outside investor, none of us would. What this means, though, from an investment perspective, is that this is something, when you read the annual report, you need to figure out, and you need to literally read, going back the entire decade, each annual report, starting in, let's say, 2010 to today, to figure out what happened and what's going on. Again, I know they went through a transition from mostly a hardware / phone seller into the 4G, 5G network build-out infrastructure, which is part of this. But I would want to know specifically how that's affected things. And that means, again, when I say I read an annual report, I read it word for word. I read the footnotes. I read everything. And I do this, again, going back 5 years, 10 years, as long as I need to figure out what happened, what's going on, what it's done over the time, to figure out if their plans are working, all that kind of stuff. So unless I did that, and even then, frankly, we might not know. They might not tell you. I don't know if they're forthright in their financial reports. Most companies, frankly, are not. They are not sugar-coated, but they're heavily, most annual reports are heavily influenced by lawyers and marketing people, or HR people, PR people, I guess I should say, to make sure this company doesn't get sued, type of thing. It's not to give you the most and best information. So it might not even say in the annual reports what the big deal is here. But unless you could figure that out, this is a big red flag. Anything else on the balance sheet? Their PP&E has gone up due to, largely to, machinery, furniture, equipment, and leased property and equipment. If that makes sense. Goodwill, I'm not going to talk about that here. I'm not a big fan of that. I've talked about it in several other videos. I think the Cody ExxonMobil videos, which are linked below for free, I think I talked about those there. Intangibles, other than goodwill, again, not a huge fan of most of these. And most of it is, frankly, probably don't bring much value, because the Nokia brand, at least to my knowledge, isn't a huge brand anymore. It might be in the like 5G specific space, but it's not like a huge brand like Apple or Samsung or Disney or Amazon or something like that, in my opinion, anymore. Amortization. Impairment. Okay. They've had to impair some stuff over the last few years, which is, again, I figured from the transition and also because of their book value going down over time. Impairments, again, I talked about that, I think, in the Cody video, ExxonMobil video. Why those are just so important, because essentially this is a yearly, annual $1 billion destruction in value of the company right here for the last 5 years, which is not good. We'll talk about these at some point. These can be super valuable deferred tax assets. We'll talk about that at some point, but not today, because this video is already longer than most of my videos. Most videos end around 20-25 minutes. We're already at 24 minutes, and I'm not done yet. Debt levels. Again, could be super valuable. These two things, deferred tax assets, deferred tax liabilities, are what you call investment float if used properly. But we'll get into that in a different discussion. They've taken on more debt, which again is not a huge surprise, mainly because of the COVID stuff. Most companies took on more debt to survive the COVID stuff, not necessarily for the transition of the business. Total provision for, okay, so I'm assuming that's like a pension, total provision for employee entitlements. We'll talk about that at some point too, because that's a whole nother discussion. Okay. Retained earnings. I've talked about this pretty significantly in the last couple of videos. Accumulated deficit. This went from a huge swing in the last few years, from positive $3.6 billion in 2016 to negative $4.1 billion in 2020, which means the company's had huge losses in that time on a net income basis, because this measures the entire profits if it's retained earnings and a positive number, or the entire losses the company's had over the entire course of its history. So in the last in the last 4 years, what this number shows is the company's lost more money in the last 4 years than it's made in profits in its entire history, because it's negative now. This is a rolling year-to-year thing. So this builds up, again, either positively or negatively. This is not a good thing when it's negative, and especially when it's fallen that much in a short amount of time. That means the company's lost a ton of money, which also illustrates why it's had to issue about 2 billion shares just to stay alive. Okay, these are new down here. That's interesting, where it talks about the debt that hasn't been there before. Okay, let's go to the quarterly cash flow statement. It's not available. That's interesting. Okay, let's try to reload this, see if it comes up. Alrighty, it's going to take me back right to the main thing. Okay, so I can see the cash flow numbers right here, and it's not coming up. So you'll see this on occasion, mainly for foreign or non-US companies. I don't know why. I don't know if it's something to do with the data feed. I don't know if it's something, what it is. But you see this relatively often with non-US based companies. Again, I don't know why that is. But just to find the cash flow statements, you'll have to go to the company's website. So on top of that, it's overvalued as well. Again, I don't care much about PE, price to cash flow, or forward PE, but I want the numbers to be under 20 for all these, at 27.4, 11.5, and 19.3 respectively. That shows the company's probably about fairly valued, slightly overvalued. This is the most important number right here, is the EV to EBIT at 18.9. I look for anything below 8 to consider the company undervalued. So this shows to me that the company is overvalued when you consider its market cap, its debt, and its cash, which is enterprise value, compared to its operating profits, which is EBIT. I want to know the cash and debt levels for the company, because I think of owning a business over the long term and as an owner of the entire business. So I want to know what those numbers are, because as a business owner or potential business owner, I would want to know what those numbers are. So this shows that the company is overvalued. Its revenue is far lower. It's selling stuff a lot slower, which means cash is not generating as much in the company, or as fast in the company, which is pushing out suppliers, paying suppliers, which is leading to these other issues, the non-profitability, or the lower profitability, which is actually higher, which is a bit surprising, which means they probably are selling higher priced products and services than they were before, which would make sense. So all in all, my thoughts on Nokia, not terrible, not great. I would say it's probably about average, honestly. I wouldn't invest in it as it currently stands due to the reasons I talked about. However, I am in this arena, and I do research the 5G industry a lot, so I do know that they're a huge player in that. As a long-term value investor, I require a large margin of safety based on what the company does now, or what it's doing now. I don't count future potential earnings and profits and cash flows when I do any evaluation. Those are icing on the cake for me. If it's a good thing, if it's a bad thing, then I look into it and it's a potential red flag. In this case, I don't know. Again, I'm familiar with Nokia through some of the sites and stuff I write for, but I don't know enough at this point to feel confident in recommending them to you, because the stuff in the future, again, is all potential. I want to be able to show you a great stock that is profitable right now, that is undervalued now, to be like, ooh, I want to buy this stock. This one isn't terrible, it's not great, it's somewhere in the middle. The main issue for me with all of this, though, is the continued share dilution. Yeah, all the other stuff, the cash flow cycle is important. All the other stuff I talked about is important. To me, the biggest issue here is the continued share dilution and the destruction of value of its shares over time, which I illustrated with this stock chart. Until the company can get more profitable, consistently more profitable, and produce more cash flow, which would require improving the cash conversion cycle, it's going to likely continuing to have to dilute shareholders, which is going to drive down the per share value of the price, which is going to drive down the entire value of the price, which is why its stock has fallen so much, or one major reason, frankly, its stock has fallen so much in the last decade, last 20 years. Until they can stop that share dilution, I wouldn't recommend buying this company for that reason. Again, regardless of what I know about its prospects and its huge prospects, I think it's the leader still in the 5G network build out worldwide. Regardless of that, the share dilution makes me so uncomfortable, I couldn't recommend buying it, even with what I know about Nokia's future and its, frankly, great prospects. Until it can stop that share dilution issue, it's going to continue lowering the per value share of the price of the company. So for those reasons, I would recommend avoiding it. And I certainly won't be investing in it at this time. I'd love to hear your thoughts. CryptoIndex. We had a lively discussion on, I don't remember which stock it was. You disagreed with my analysis, but we ended up having a great discussion on it. I'd love to hear your thoughts on this, since you recommended I look at this stock. If you're listening, anybody else have any thoughts? I'd love to hear them. If I missed something, if I didn't explain something well enough, let me know in the comments below. If you want me to look at a stock like this for you, let me know in the comments below. I've now looked at, let me get my screen back here. I've now looked at, I think, 50-ish total companies. What's happening here? There we go. And I think probably about half of them have been for people on YouTube asking me to look at stocks for them, including for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, at least the next 11 videos on my calendar are for people who have requested me that I look at stocks for them and do an analysis of them. If you want me to look at a company for you, I will look at a company anywhere in the world. The only stocks I will not look at are banks, because I don't evaluate them, and insurance companies, because you have to actually dig into their annual reports to figure out if they're a good stock or not, or a good potential investment or not. Other than that, if you want me to look at a stock anywhere in the world, I'll look at a stock for you. Just let me know in the comments below. If you like this, make sure to like, love, share, subscribe, all that good stuff. Make sure to hit the notification bell, because we're releasing new content all the time, and this will notify you when releasing new content. If you're listening on the podcast, all that good stuff as well, we'd really appreciate it. We'd also really appreciate a review, because the more reviews, views, and listens we get to our content, the more people we can help. If you want to if you want to learn faster about how to evaluate stocks better and faster, we have some free resources for you below. 5 free gifts, including the full written analysis worksheet that we just went through, preliminary analysis worksheet we just went through, the whole full version of that. You can get that for free below. You can also get a free copy of my book, PDF copy of my book, How to Value Invest, at one of the links below. And you can also get access to our guide, 7 tips to picking great stocks and 3 times you must sell. You can get all that for free below. If you're looking for more specific help from me, we also have information about our value investing masterclass below as well, so make sure to check that out. But until next time, have a great day. Talk soon. Bye.